Ultimately, banks, for the most part, are in the business of borrowing short to lend long. So when the curve flattens, that's typically not good for kind of their business longer term. Now, there's a lot of moving parts in that they're not actually lending at 2-year, 10-year. It's quite a bit shorter, and the short-term rates tend to reprice earlier. So I think there's some movement around it. But it's hard to argue that a flattening yield curve is good for bank stocks. And really, we're seeing a tough market today, right? I mean, the S&P's down 2-3% on a lot of the trade concerns, but the bank decline's been really profound. You're talking down 5-6%. And I think rates are the first place you really have to look at as to what bank investors are looking at and what they're getting concerned about.
So don't be too concerned about the flattening yield curve. I mean, it's a factor. The bank stocks have been trading along with it. Is there something bigger? I mean, what are you hearing from investors in terms of why there is such a doubt when it comes to banks when their price to book values look pretty decent?
Well, when I say what I'm hearing from investors, there's really two groups I'll talk about. One is bank specialists. These are people who look at banks, look at financials only. For the most part, I'm hearing from them that, yeah, the curve's inverting, but there's really nothing else bad going on in bank land. It's very good right now. The question is, can it actually get better? The second group, and I think where we're seeing a lot of the selling, is kind of more your generalists who don't have to invest in financials. They can invest kind of across the board. I think that's more where you're seeing people say, well, if the rate environment's getting worse, do I really want to be overweight or long the group that's most exposed to it? And, you know, a lot of money flowed into banks after the Trump election. We've seen a lot of it come back out again. So it kind of depends on what investors you're talking to.
In terms of the investors who only look at bank stocks or look at bank stocks with a special focus, are these long-short funds? I'm just trying to get a sense of whether or not they're just sort of conditioned to be long banks anyway, and so you're sort of getting a skew point of view.
Well, I think that the real question they're asking is what are banks going to do for an encore? I mean, because as I said, there's a lot of good things going on in bankland right now fundamentally. Eventually, credit has to turn. Now, it hasn't turned yet, and we've been saying it has to turn for a number of years. The good news is it hasn't turned, and we keep thinking it will. The bad news is every day it doesn't turn, you're getting closer to the day where it does. But I think investors are kind of looking forward to say, what are you going to do for kind of earnings growth next year off of what's a really good environment here now? And that's what pushes me more to looking still, especially after today's sell-off, at some of the larger cap banks. I think with the larger cap banks, the B of A's, the JP Morgans, the Citis, the Wells Fargos, you get, you know, they're in a better technology position.
Right.
I think you see better opportunities for more efficiency there. Their capital positions tend to be stronger, and they've all got investment banks in them. And in a decent economic environment, you want to be owning capital markets firms.